Well, if I think it's kind of continuing what we talked about last Wednesday from our conference, where you didn't relieve the overbought condition enough, and I think there's a lot of excuses between the trade wars. I mean, tragically, between the trade war, what's going on in Hong Kong, and some other issues that are out there, have driven the fear up, which kind of makes the bond surrogate trade appear to make sense. I think yields are pretty close to their low at this point, and think about this: what really has hurt the market in the first half hurt the economy in the first half of this year, and it was the bull story all along, was the higher rates from 2018. So once this correction plays out, and I think it's pretty close to it, the bull story for the second half of this year going into 2020 is you actually get stimulative growth from the lower rates that we're getting now. So until you really shut down the availability of money, these lower rates are highly stimulative. So just so people didn't think there would be a slowdown because things were so good in 2018, I think the opposite is true today, which creates opportunity.
So when you say stimulative, Tony, are you referring to the boost it could give to the economy, to the consumer, to businesses, or specifically to the effect it could have on markets and equities?
I think it's both, but truly it's ultimately stimulative to economic activity. Housing should be picking up pretty dramatically. And again, all of this centers around people can't imagine me ever being bearish, but we were back in 2008 because you had shut down the availability of money. As long as the availability of money is still open, which all indications are that it is, when you get a drop, just imagine you've gone from a 3.25 10-year down to where we are today, around a 160. That's extraordinary drop in interest rates that is cheap and dead both on the consumer, household, and business level. Ultimately, if you provide money, we'll take it and we'll spend it.
Victoria, you said earlier you like the staples. Are there any of the cyclical sectors that you have exposure to that you'd be adding given the pullbacks?
I'm not sure we would be adding to any of the cyclicals right now, but we're not coming out of those names. I mean, we're keeping them in the portfolio for the long term. I mean, we've seen financials get hit. We've seen some of the other names get hit, but we're not getting rid of those. One thing I do want to touch on that Tony mentioned is having to do with the mortgages or the applications with the lower rates. We've seen that go up. The Fed Senior Loan Officer Survey came out last week. They showed mortgages up over 50% over the last quarter, and the banks are saying their lending standards are still easy, except for maybe subprime and autos where they're getting a little bit tighter. So I think there is some follow-through that we can see from the lower rates, as Tony was mentioning.
Tony, you said at the top that you didn't feel markets had, today's sell-off was because you didn't feel markets had really corrected enough last week and from the most recent highs. What further percentage decline do you think would suggest we had pulled back sufficiently to allow a more meaningful climb into the rest of the year?
So, well, if we did a study that found that when the American Association of Individual Investors, when the bears versus the bulls is minus 25 or worse, it's happened 4 times this cycle, what you get is a almost 3% decline from where you get that. So that would equal about 2850-ish on the market. So really not that far from here. It's more on time than it is on price. Typically when the VIX spikes like it did last week, that's kind of your real oomph to the downside. And then what happens is you kind of grind back down and even marginally touch the low, marginally break the low, and then kind of rip it. So to dovetail with what we've been talking about, I think the one place that I would have, I don't know if I want to say totally avoid, but if you have a significant overweight in the bond surrogate trade, I might think about taking reducing that extreme overweight. I think that's fully priced in. And again, as you know, we're looking for further rate cuts on disinflation fear, but that should make the 10-year go back up, which will hurt that trade.